Hello everyone and welcome to Learning FM with Tushita Gupta. So here we are talking about the March-June 2025 paper. When I'm recording this video, this is the most recent past paper which is available. And here we are solving the very first question from this paper, which is Sulu company. So this is based upon investment appraisal. That's the area that it is testing. This is a very common, I would say, most anticipated syllabus area when it comes to being tested in the FM exam. So no big surprises that investment appraisal is getting tested over here. Let us get started now. So I can see that the first requirement wants me to calculate the NPV of the stopwatch project and comment on my result for 6 marks. This is only that I'm supposed to do for decision 1. That means in the case study, there are multiple decisions with which the organization is thinking about. So we are supposed to let them know that which for the decision 1, what is the NPV, and then we have to comment also. Comment means we have to let them know that should they be going ahead with it or not. So let us get started. Sulu company is a profitable company which manufactures sports equipment. Sulu company uses NPV when appraising new product projects, and it is currently appraising 2 investment decisions. Decision number 1 is Sulu company has developed a new type of electronic stopwatch which it claims is more accurate than any other currently available. The development team have already put together a basic financial appraisal to justify manufacture of the stopwatch for the next 4 years. The details are as follows. Year 1, 2, 3, 4, we have been given with the profit or loss before taxation. So that means apart from doing taxation, all other things have been adjusted. Like how we do a normal NPV question, we start from the revenue minus costs and all of those things. That has already been done for us. Now, let us start by creating a little bit of a format for ourselves. Yeah, I think we will be done here. So we have our years 0, 1, 2, 3, and 4. Till the 4th year, we are doing the production. And here we are going to be starting with the forecast profit. So in the first year, it shows me negative 75,000. Second year, it shows me 25,000 positive, 105,000. And then the 4th year, it shows me 65,000. So now I have all the figures which are by default given to me. Now let's read the question further. The above forecast figure include research and development costs incurred to date, totaling $200,000, which have been amortized over 4 years on a straight line basis. So this $200,000 that we have incurred in research and development, this is something that has already been incurred. So going by, the rule that we have learned over here, what we are supposed to do is we are going to add back these research and development costs because these are sunk costs. According to the principles of relevant costing, we have understood that sunk costs are not to be considered in investment appraisal. So we are going to remove the impact of these costs. So I'm going to add back R&D cost. So it has been given to me that 200,000 amortized over a period of 4 years. So that means every year I have subtracted this much amount, $50,000 from my profits. So this is something which I am adding back. Why am I adding this back is because this expense has already been incurred. This is not going to be incurred in the future. So something, if it is already incurred, we account for it as a sunk cost, and sunk costs are to be excluded from our investment appraisal. So I have added back the research and development costs. Now let's move further to reading the question ahead. The production machinery for the stopwatch project will cost $600,000 incurred at the start of the first year of operation and will have a 0 residual value at the end of year 4. Depreciation has been included in the above figures on a straight line basis over 4 years. That means depreciation has also been subtracted. They have assumed a zero residual value, and for 4 years. That means how much depreciation have they charged each year? So I'm adding back depreciation because depreciation is a non-cash expense. We are not supposed to reduce that from our cash flows. So if it has already been reduced from these numbers, I have to add it back so that I get before depreciation cash flows. So 600,000 has been written off over a period of 4 years. That means per year 150,000 would have been charged. So this is the amount of depreciation that I have added back because this is not a cash flow. Now I will be able to find out what is my operating cash flow. Operating cash flow. So this is going to be this plus this plus this. Hit enter, you have your operating cash flows. Right. So these are the cash flows which are going to be there from our operations. Now, on the operations, we are supposed to pay the taxes also. So let us do the adjustment for the taxes. The further information tells us Sulu company pays corporation tax at a rate of 20% and it is paid at the end of the year to which it relates. That means first year's taxes will be paid in the end of the first year. So that means I will be charging tax at the rate of 20% over my figures in the same year itself, minus 20% of the above value. So this is what it is going to look like. This is, I have added my tax adjustments also. Now this is only the tax that I'm going to be paying on my operating cash flows. I have to do further adjustments. Let's read the question. The machinery is eligible for 100% initial tax allowance in the first year of production. This has not been incorporated in the forecast figures. What does 100% allowance means? That on the total value of my machine, how much is the total value? 600,000. On this total 600,000, I will be able to get 100% on this value, I will be able to get the tax allowance. So that means I will be putting in the benefit because of this. So I put in the outlay first here. Outlay is the expense, the money that I will spend to get this particular machinery. So this is a negative figure because money will go out of my pocket, minus 600,000. Right. Now I am going to take the TAD benefit. Now it is telling me that entire benefit over the whole 100% amount I will be getting in the first year of production. So in the first year of production, I'm going to get off 600,000 a 20% tax benefit. So I will multiply this with minus 20% so that I get a positive number here, or otherwise I can change the minus sign later. So what you can also do is, instead of putting a minus sign here, you can put minus the outlay into 20%. So this is the benefit that you are going to get in the very first year. Now we can find out finally our net cash flows because there are no further adjustments. We are just given with the nominal cost of capital. So I will just find out my net cash flows. We were here and we've done the further adjustments. There is zero residual value, so I don't have to do anything related to that also. So this is what my net cash flows are going to look like. Now, after my net cash flows have been calculated, I simply have to discount the cash flows and find out the NPV. So for NPV, I will simply use the NPV formula equals NPV. Cost of capital is 12%. We select the cash flows right from year 1 till the last year, and then you manually subtract the initial investment. You've already put it as a negative sign in front of 600,000. So no need to put another negative sign because it is going to add it otherwise. So this is how we find out the NPV for this particular project. And we can convert it to the currency format. This is what the NPV is going to look like. So far we have calculated the NPV. And now we are supposed to comment upon our result. So because the NPV has come out to be a positive figure, we will say that the NPV is positive. So the stopwatch project is financially viable. We will leave a comment here. The NPV is positive. Hence, the stopwatch project is financially viable. viable or acceptable, whatever word you want to write. This is how you can frame your answers. NPV is positive. Right. So this is how you can write your answers. So with this, we are done with the first requirement, which pertains to 6 marks. Now let's move further to the second requirement. For 5 marks, we're supposed to tell that for decision 2, we're supposed to determine the optimal investment plan and the resulting NPV. So here is the information given with respect to decision 2. It is telling me that Sulu company is also considering 5 other projects with the following details. There are 5 projects with the outlay as well as NPV given to us. So what we can do is we can firstly copy paste these numbers. You people also start thinking how you're going to do the workings here. We know that whenever we have, okay, let's read the question further. All 5 projects are divisible and not repeatable. None of the 5 projects can be delayed. A and B projects are mutually exclusive. Due to hard capital rationing, finance for these projects is restricted to $2.1 million. The finance required for the stopwatch project in decision 1 is not included in this constraint. So we are supposed to tell them that with the limited money that they have, $2.1 million, what is the best plan that they should be doing. So we know conceptually we have learned that we calculate the profitability index, which we call as PI whenever we are short of money. So there are 5 projects, A, B, C, D, E. Outlay is given to us for each case, 510, 850, 417, 950, and then it is 600. Then the NPVs are given to us, 195, 350, and then I see a negative 200. Do we ever take a project with negative NPV? No. So project C we will straight away exclude from our calculations. No business will take up any loss, right? And then you have 400 and then it is 215. Now we will work around the profitability index. Profitability index is simply NPV upon the outlay. So this formula you can copy paste and see we are going to eliminate. So I'm not copy pasting the formula there. And here, okay, NPV upon outlay, right. So here we can say that we are simply going to reject this particular project. What we can do is we can put a restriction to 2 decimal places so that it looks also neater, and we will be able to decide also easily by the rounded off figures. So we have our numbers right over here. And what we are going to do is we are first going to produce the ranking for these. So the very first ranking that we are going to give is 1.59. Just a moment. I can see that the formulae have been incorrectly placed here. The copy paste did not actually work. Do not worry, you people. It is going to be absolutely fine when it comes to your actual exam. So now we have the ranking. Let's double check. Yes, now we will be able to do our ranking. The highest number that I can see is 0.42. Apart from that, I have 0.41. Then the third ranking I will give to the project A. And then the fourth ranking, for this one, there is no ranking. Fourth and the last ranking I will give to project E. So now I have worked around the rankings. Now I will tell that how much of the project can I possibly take. So I will write how much percentage of project will be taken and how much will be the outlay, and then how much will be the NPV. So when I talk about my first project, the project which I've given the first ranking, I will take that completely. So 100%, and outlay that I'm going to have in this case will be 100% of the outlay which has been given to us as 950. So out of the total money that I have with me, the total money that I have with me is $2.1 million. So this is all in terms of thousands of dollars. So we will remove the 3 zeros from 2.1 million. So I basically have 2,100,000 with me. So that means 950 out of this is utilized. This will give me an NPV of 100% into the NPV of this project, which is 400. Next, I will take up the project which I have given the second ranking to. Second ranking I had given to project B. I will also here also, because 850 is still left with me, I can take up the whole project. So 100% into 850, and then the NPV which I will get will also be 100% of 350. So till here, how much money have I used? I have used 850 plus 950. 850 plus 950. That means I have 1800 used. That means 2100 is my total. 1800 has been used. What is the difference? Difference is the amount that I have left, which is 300. Now I will choose the third ranking, but it was told to me in the question that project A and B are mutually exclusive. If project A and B are mutually exclusive, I've already taken project B because B was giving me more PI than project A. Now I will move to the next ranking. I cannot do project A because A and B are mutually exclusive. I have already invested in project B. Now I will go to the next ranking, which is of project E. I have 300 left with me. So here I am going to choose half of this project. 600 is the total outlay needed, but I only have 300 with me. So the proportion that you will get here is the remaining amount divided by the total that you need over here. You can convert it to a percentage. So you will be getting 50% over here. Two decimal places, percentage. Yeah. So we have 50% of the project that we are taking. So the outlay will also be 50% of 600, which will be 300. And the NPV that we also get will be 50% of 215, which is 107.5. So if you do the total equals sum, this should equal to 2100 because that is what you have. That's the maximum that you have. And then how much NPV will you be able to generate from this? The total of these three numbers, which will be 857.5. So this is how you get to know that this is the money that you will be able to earn. So to give our final answer, resulting NPV, we will say that the optimal, this above is the optimal investment plan. Optimal investment plan, and it will result in an NPV of 857, you can say 857,500. So this is what you will write. This is the NPV that we will be able to generate using this particular investment plan. So here we have given the answer for the 5-marker requirement. Now let us proceed further. Part C wants us to discuss 2 reasons why Sulu company may be subject to hard capital rationing. So let's just have a quick recap of the concepts that we have learned. There are 2 types of shortages in capital that a business can face. First is hard capital rationing. Second is soft capital rationing. Hard capital rationing is when people outside of my business are not willing to lend money to me. So they may have put a limit on my company that this is the maximum that we will be willing to lend to you people at Sulu company because of XYZ reasons. Maybe there are industry factors, maybe we are not doing well, maybe we have defaulted earlier. So there could be XYZ reasons. Another capital rationing is the soft capital rationing, where the capital is limited because the inside management wants us to productively use the funds. They are going to put a limitation that this is the maximum money that you will be getting. So it is not a problem from outside. This is something that we are doing to maximize our performance. But when we are facing hard capital rationing, this means people outside of the company are not willing to lend us money. So what could be the particular reasons that you could talk about? First, you could talk about the industry factors. What are industry factors? That may be the outlook of the industry itself. Sulu company is dealing in the sports equipment industry. So maybe there's going to be a recession in this particular industry. Maybe other companies operating in this industry are not doing so well. Maybe they have defaulted on their loans. So the investors, the lenders may be worried that Sulu company will also default on the loan. Another factor that you could talk about is the track record. Track record means the credit rating and the credit history of Sulu company. Maybe Sulu company has a bad history in paying interest on time, in paying the dividend to the investors on time. So maybe the shareholders, the lenders are not willing to lend any more money to Sulu company. Even though it is mentioned in the first line itself that Sulu company is a profitable company. So this thing seems quite less likely, but this can also be a potential reason. Another reason that you could talk about over here, even though only two were asked, third reason which you people can mention here is about the asset availability. What happens is whenever you go to a bank to take a big loan, what do banks want? They want a collateral. They want insurance that if you do not pay the money that you have taken from them, they should have other sources from which they can recover that money. So they keep your assets as a collateral with you that in case you do not pay, they will sell off your property, they will sell off your building, they will sell off your land and recover the money from that. So if let's suppose Sulu company does not have a lot of properties, a lot of assets which they can give as collateral, then also it can be a potential reason why investors or lenders are not willing to give money. Fourth, another thing which you could talk about is the risk profile of Sulu company. What do we mean by the risk profile? Risk profile of Sulu company, you could say that maybe the lenders are feeling that there are some other things happening wrong with Sulu company. Maybe the management is changing. Maybe the shareholders are changing. There's a change in ownership. There's a change in management. As a result, Sulu company, how well will it be able to continue further in the future? That is something which is getting dicey. So these are a few factors that you could talk about over here to obtain these 4 marks. Only 2 were required. That means you will explain 2 reasons properly to get these 4 marks which are available. Very easy requirement. Now let us proceed to the last requirement pertaining to this question. 5 marks, we have to discuss the usefulness of to Sulu company of using the ROCE as an investment appraisal method. So always remember guys, this is a 5 marker requirement. You're supposed to talk about the usefulness of ROCE to this particular company. That means you cannot write a generic answer. You have to link your answer to the scenario. You have to keep mentioning Sulu company again and again so that you make the examiner believe that you have written your answer tailor-made for Sulu company. Also, one more thing to note is 5 marks to tell the usefulness. That means we cannot give a biased answer. We have to talk about both the sides. What are both the sides? Advantages as well as disadvantages. So ensure that you people give points from both sides. Ensure that you give a balanced answer about advantages and disadvantages. Firstly, if we like to talk about advantages, we know that ROCE is a relative measure. In advantages, you could write 1 point that ROCE is a relative measure. What do you mean by relative? It is very easy for comparison. And even the people who are not related to a finance background, they can also easily understand it. If the management at Sulu company is not, coming from a finance background, then ROCE can be very useful because they will be able to understand it more easy compared to NPV. So you can, another benefit that you can say over here is that it is more easily understood than NPV, because currently they are using NPV at Sulu company, right? And another advantage that ROCE offers is that analysts all around the world use the NPV, use the ROCE to appraise the performance of the companies. So if we start appraising our projects also on the basis of ROCE, we can ensure that the ROCE numbers of Sulu company as a whole will look like a good figure. Then talking about the disadvantages which are associated with ROCE, you could talk about some problems that are there. Firstly, it does not incorporate the time value of money, does not consider time value of money, because there is no discounting of cash flows that we do in ROCE. Another thing that is a disadvantage is that it uses profits rather than cash flows, profits can always be manipulated, books of accounts can always be manipulated. And even with different accounting policies, we get different profits. If I use written down value of depreciation, if I use straight line method of depreciation, my answers, my profits are going to differ. So another thing that you can write, another disadvantage that you can write is that it does not give a clear decision rule. Like in NPV, we have a very clear decision rule. If the NPV is positive, you accept the project. If the NPV is negative, you reject the project. But when it comes to using ROCE, there is no particular decision rule. It just gives you that this much percent is the ROCE of this project. But if you have to decide, you will have to have a target rate, and that target is subjective. Some human will have to decide it. So we may make mistakes in setting that particular target. So these are a few points which you could talk about for 5 marks over here, and you will be able to score well in this answer. So this was the solution of Sulu company. I hope that with this video, you people were able to understand this question in a better manner. And I'll see you in the next video. All the very best if you're appearing for the FM exam anytime in the near future.